Hello, everybody. Welcome. Hello. Hello. Hello, everybody. Welcome to our session with Dr. Will Quinn from Queen's University, Belfast. We're going to discuss this, boom and bust. There are copies outside that you can buy, and Will's going to be wandering around all day, and he can sign them. Dr. Will Quinn is a senior lecturer at Queen's University, Belfast, which you might already guess is my alma mater. From the accent, Queen's is one of the few universities that's really taking financial history quite seriously. Will's actually in the business school, not in the history faculty. So send your children to Queen's University, Belfast, is my, if you want to get them a good grinding in what really counts in business and finance. This book was voted one of the FT Economics Books of the Year, and in the world of financial history, it's a bestseller. So it's quite an achievement. Now, I have been involved in lots of booms and busts because I started my career in investment in 1989. So that includes being there for the top of the Japanese stock market, actually the Taiwanese stock market as well. Both of these stock markets only recently surpassing that high of 1989 to 1990. So the dot-com bubble, the great financial crisis, the Asian financial crisis. Will and John, his co-author, have done us a great service in writing this book because it's focusing on why these things happen, why we get excessive valuations, and why they come to an end. And lots of people have tried it before, so you're not the first people to try and do this. But I think the reason it is a bestseller is because it does it in a very different, new way, which I think is useful. And you will be glad to know that the final chapter of this book, if you buy it, is called Predicting Bubbles. So we might try and do a little bit of that as well. But we're going to begin with the overriding thesis, which is called the bubble triangle, having studied all of these bubbles. We'll talk about that as a formula or a schemata for how they happen, and then we'll go and look at some individual bubbles that have happened, and then maybe try and talk about the future a little bit at the end. So, well done, and tell us about the bubble triangle and how it helps us work out whether you're in a bubble, and maybe even when that bubble might be coming to an end.
Yeah, thanks for having me, Russell. So the bubble triangle, this is our model for thinking about how bubbles occur, what causes bubbles, because one of the things which surprises people is that in history we have long stretches of time when there aren't any bubbles or aren't any major bubbles. If you go from the Wall Street crash to the Japanese bubble of the 1980s, there's very little going on. This is when academics start to believe that bubbles are a myth, that the efficient markets hypothesis really takes off because from most people's living memory, they can't remember anything like this actually happening. So that makes us think that there must be a cause, there must be some kind of context that makes bubbles possible, it makes bubbles more likely. And we came up with this model, which is based on the fire triangle of chemistry, where if you have oxygen, fuel, and heat, then a fire can be started by a spark. So this is the bubble triangle. The fuel is what Edward was talking about last night, so money and credit. Money, we'll start with credit actually, because it's the most straightforward. So whenever interest rates are very low, people can invest in a bubble asset with borrowed money, people will reach for yield. There's a lot of debt growing in the economy, and this provides the fuel for bubbles. Money can also play a role, even in the absence of credit. This can be things like foreign investment coming into a particular country, just flowing in and inflating bubbles. It can be from an era of strong economic growth. So if you think about the 1920s in the USA, there's a lot of economic growth. People are earning more money and having more savings, and that finds its way into the stock market. The oxygen is the marketability. And what we mean when we say marketability is really liquidity, but very broadly defined. So the ease of buying and selling assets. It's much easier to get a bubble in an asset that's easy to buy and sell because it's more fun to speculate in. So basic increases in marketability very often precede financial bubbles, something like the introduction of mortgage-backed securities, where you take illiquid mortgages sitting on a bank's balance sheet and transform them into something that can be bought and sold very easily on financial markets. You can also think of something like a fall in transaction costs, which makes buying and selling assets a lot more easy and it makes it more appealing to buy and sell frequently, which is the essence of speculation, which is the third side of the bubble triangle. Or you can think of technological improvements, something like app-based trading, where you can buy and sell a crypto asset or a meme stock 100 times before you get out of bed. These are all increases in marketability. And then the third side is speculation. So speculation is where you're not really thinking about how much an asset is worth, but you're buying it because you think the price is going to go up. And this is the hardest part to measure. We're mostly quantitative historians. We like to try to find things we can measure. Some things are very difficult to measure, but if you're into the history and the qualitative factors as well, you will notice that this is how people are thinking a lot during bubbles. We find strong evidence from things like survey data. During the Japanese bubble, you surveyed investors and a lot of people were saying, look, we know these assets are overvalued, but we think they're going to become more overvalued, and that's very clear evidence that there's more speculation going on. So whenever you have these three sides in place, what determines which asset you get a bubble in, or which assets, because sometimes it affects multiple markets at once. And we say, generally for major bubbles, the spark comes from either politics or technology. So technology is quite straightforward. This is something that people find very exciting. Something like the internet is the most obvious example, where the existing firms are making a lot of money, so you have rapid capital gains, which then attracts these speculative momentum traders. You have often narratives about the new technology, that it's going to change everything, that our usual metrics for valuing firms no longer apply because this is so revolutionary, and so on. The technology is something that people get very excited about and often becomes the focus of a particular bubble. On the other side is politics. And this can be many things. It's very often a deregulatory move, a type of financial deregulation, which makes it, causes an increase in marketability or credit in many cases, something like the extension of mortgage credit, which preceded the 2000s housing bubble. We also have in the 1720 bubbles, where the spark was this move to set up a company as a way of reducing the burden of the government's debt, which in France blows up spectacularly, but in the UK, they managed to actually kind of pull it off by creating this bubble company that allows them to convert the debt. So politics can be a lot of different things, and the political bubbles tend to be the more destructive ones, but those are the two sparks, and this is the bubble triangle.
Yeah, I was interested in bank deregulation. I mean, I have seen that 3 times, a deregulation of the savings and loans, a deregulation of the Australian banking system, and Jared's just told us about the deregulation of the Icelandic system. Do you know of any banking deregulations that didn't create bubbles? I mean, it seems to be that the bankers, once freed from the constraints on their balance sheet, basically don't really know how to lend, certainly not at the pace that they go on to. Kind of an unfair question, but have you, which ones didn't produce bubbles? They all seem to produce excesses, right?
Well, quite often you get a bubble immediately after a deregulation, and whenever the bubble collapses, then the deregulation stays in place and you reach some kind of new equilibrium. I'm sure there are many examples of laws that weren't so major, some kind of financial deregulation. You know, not every cut in interest rates or removal of a restriction immediately results in a bubble. You also have countries where a bubble doesn't happen. So it's certainly not the case that you see banking deregulation and immediately think, oh, a bubble is coming, but it is one of the harbingers of a bubble.
Yeah, so the speculation thing, that is the difficult thing. Having lived through them, it's knowing how long they can go on for. And there is a gentleman called Gordon Pepper, who some people here may know, who has been in the financial market since 1963. And Gordon has a thing he calls Pepper's Law, because he's modest. And Pepper's Law is that you use your bubble triangle, you use money and credit, you use marketability to assess how long you think these things can, as you say, remain above fair value. You try and work out rationally how long it can last, and then you double it and take off a month. Because the speculation bit, I think it's almost impossible. So you didn't find any little tricks that could help. You said the surveys. You think the surveys are probably the best way to try and get some handle on how this goes on?
Surveys are a good measure of speculation, but typically we only have access to them in hindsight. Yeah. So as a financial historian, this is great for me because you say, well, we've got great evidence that there was speculation here. But at the time, as an investor, it's much harder to find something quantitative, some kind of a measure of it.
If you can find anything contemporaneous, there's a good business in this world if you can.
Right, exactly, yeah. I know people now are monitoring social media sentiment, so you can see how many people are talking about something. I heard people say, that the time to sell an asset is when Elon Musk tweets about it. So that's like once it gets there, you're sort of at the maximum point of hype, and after that, there's nowhere to go but down. So I think also some people just have a very good sense of it. They just sort of see socially where the hype is coming, and then also get a sense of when it's going to end.
There's an intergenerational thing here. I was going to leave it to the end, but I thought I'd bring it up now. This quote from your book relates to the dot-com bubble, but it's about young people and old people in a bubble and what's really going on. So I'll read it. It says, mutual funds with younger managers performed worse than average. This is during the dot-com bubble, as they were generally much more heavily invested in technology stocks and more likely to exhibit trend-chasing behaviour. By one estimate, in the month before the Nasdaq peaked, insiders, however, sold 23 times as many shares as they bought. As is often the case, speculative investment strategies were much more profitable for experienced investors and those with privileged information. So in a bubble, are we watching old people taking advantage of young people? Or are the young people, talk about that, because I've seen a lot of them. And obviously we've just seen this meme stock thing. There's a great movie about it, Dumb Money. Talk about this intergenerational thing that you think is going on from that data and that study.
Yeah, so it's an interesting study. There's a couple of interpretations because these are mutual fund managers. They're not investing using their own money. So one interpretation is young people hadn't seen any of this before, that they didn't have this experience of having lived through, say, the 1987 crash or the Japanese stock market bubble. So they think this is great, these stocks keep going up and we keep making lots of money, whereas you have older, wiser heads who understand what's happening a little bit better. The other interpretation is that they have different professional incentives, where if you're older, maybe you're a bit more secure, maybe you don't feel such a need to go and prove yourself. One of the big problems, which Russell has direct experience, is if you're working in a bank during a bubble as big as that, it can be a big problem if you're going against the herd. So it could be the case that it's 1998 and you say, okay, these internet stocks are in a bubble, I'm going to start going short on them, or I'm going to sell all of our internet stock. And then for the next 2 years, everyone else in the company is making lots of money and you're losing lots of money. So if you can keep your job for those 2 years, then that's great. You'll get paid off eventually, but a lot of the time you can't. So there's this incentive to just succeed when everyone else is succeeding and fail when everyone else is failing. And maybe that's a bit more pronounced for the young investors than the old investors.
Yeah, it's really interesting because in economic theory or financial theory, there's a balance between the informed investor and the uninformed investor. Crudely, let us just say that's how this splits up. But what you've just described and what I've experienced is in a bull market, the so-called informed investor really gets shut out and becomes the uninformed investor and has to not all of them, but some of them get forced by the incentive structures in their firms or whatever. And suddenly you've got all these uninformed investors and very, very few informed investors. And there's this switch, and I wondered if maybe there's some way we could track that to give us an idea when there's more uninformed. Maybe it's marketability, maybe it's degrees of turnover, maybe there's something that says this is when there's too many people betting on short-term capital movements and not the so-called informed investor who's looking at value.
Yes, so it's this interesting split, as you say, is informed and uninformed investors. And obviously, we know it's a simplification, but we've got more work ongoing where we're looking at who actually are the people that lose money in a bubble, for past bubbles where we have particularly good data. And what seems to be the case is you have informed investors, the insiders, who make money. You have completely uninformed investors who generally stay out of the bubble altogether. And then there's this danger zone where you think you know enough about the bubble to make money out of it, but you actually don't. And those are the people who actually end up losing money.
Yeah. Well, just to be clear, smart people also lose money in bubbles.
Oh, yeah.
Sir Isaac Newton being a prime example in 1720, who I think sold at a profit, but was sucked back in again and lost all his money. So it's not just about young and old people who are losing money in bubbles. You cover lots of bubbles in here, and some of them are well known. This is an informed audience. I thought we'd pick one of the less well known ones, which is the bicycle bubble. Now, I think it's really interesting because it is a technology, actually transformational technology, and a socially transformational technology. But it's not a bubble that gets a lot of coverage. And I wonder if you could talk about that particular bubble, and particularly because there's an amazing, colourful character at the centre of that called Terence Hooley. Terence Hooley. Now, this being Hay, he's probably got one of his descendants is probably in the audience. But Can you talk about the bicycle bubble, how that fits into the framework here, and Mr. Hooley and what he got up to in this bubble? Because one of the things in this bubble is new issues as well, and that's not in the triangle per se. I guess it's part of marketability, but a lot of new issuance comes. So talk about the bicycle bubble and how that played out.
Yeah, so the bicycle bubble was in the 1890s in the UK. It's a bubble in the shares of bicycle companies, which is really the result of this transformation from your old-fashioned Victorian-era bicycle. Probably have an image in your head of the very large front wheel, the very small back wheel. These were horrible machines to ride. The most popular and most comfortable model was nicknamed the Bone Shaker. So generally they were, I like to say, they were only really used by people who 100 years later might have been riding Segways around California. The transformation was whenever you have the introduction of the pneumatic tire, which makes these much more comfortable, the steel frame, the chains, ball bearings in production, which allow them to be mass produced, and suddenly bicycles become much more popular. And at existing bicycle companies, this is a major boon to their business. They start making a lot of profits. And one of the companies, which is called the Pneumatic Tire Company, is taken over by this man, Ernest Terah Hooley, who's a kind of a charlatan, a sort of Del Boy figure of the time, who comes up with this idea that he's going to buy these companies and then sell them on the stock market or issue them on the stock market for many times what he originally paid for them. So he buys out the Pneumatic Tire Company, combines it with a couple of other very small companies, and then refloats it as the Dunlop Company. And makes a profit of about £2 million at that time. And whenever other people see that this can be done, every small bicycle company in the Birmingham area has these promoters come into the doors saying, oh, we'll buy this company out for more than it's worth, and then they'll float it on the stock market for even more of that. And this is accompanied with a share price boom where the existing cycle companies, the share price booms and it attracts momentum traders. And in a very short period of time, they're trading way above any kind of reasonable measure of fundamental value. So this is the bicycle bubble.
Can you remember how many new issues? I mean, how many bicycle companies did we get to at one stage? I mean, it wasn't 10 or 20. It was a lot more than that, wasn't it?
It was about, I think, about 800 in the space of 18 months. So a lot of them were aborted. So they sort of tried to float them, and then they didn't come out. The ones that actually got traded to the point where the Financial Times was reporting the share price, there was about 160 of those.
Right. So what you do at Queen's is you do a lot of sort of what I would call financial archaeology, going back into the newspapers, looking to find these names and the share prices, and then recreate indices for how these things performed. So financial archaeology. Is that what you call it, or what?
Yeah, that's a big part of it. It's going into these old sources that haven't been tapped for some time, and especially, as I said, trying to find something quantitative. I'm working in a business school. I always have to justify history to economists and other people who just work in mainstream finance. So finding some data is often very important, and ideally you find a type of data that you don't have for modern markets, where you can say we can learn things from this that we maybe can't learn today, especially when it comes to something like investor identities, where you can see who is holding the shares at different times.
Yeah. So something else is going on in the 1890s. There's also a speculative boom in South African mining stocks. But to go back to what Edward was saying last night, that famous quote from Walter Bagehot, John Bull can stand many things, but he can't stand 2%. So it just happened that from the end of the US Civil War to I think 1894, we had this long decline in interest rates. So presumably the inability to get a decent yield on your money was also whipping up interest in a more speculative way to get a return than take the 2% on bank deposits or gilts.
Yeah, absolutely. So 1890s, interest rates were lower, I think an all-time low for that point in time. So we had it popping out in South African mining stocks. We had it popping out in Western Australian mining stocks. It comes out in bicycles. It also comes out in breweries. I think it also comes out in whiskey, which you're going to hear a little bit about later. It's all in the same era. But maybe one of the interesting asides there is that whenever these things blow up, there's not a lot of economic damage, which I think partly explains why they're forgotten. It's not that unusual to have a bubble burst, and there's not too much economic fallout. And the reason for this is that it's people are generally investing their own money. So whenever you get this combination of bubbles and debt, and especially when the banks are involved, that the financial bubbles can become a serious problem.
I mean, it's a great point because the 2000 to 2003 bust in the dot-com bubble, it did bring down some companies, but they weren't banks. I mean, there were things that went bust, but the banking system stayed rock solid during that period. Well, rock solid might be too strong, but there was no question of a banking crisis through that period. So that was an interesting example of one of these bubbles. And it's in Keynes, isn't it? He said if speculation remains a mere bubble upon a stream, it's nothing to worry about. And there is a form of bubble that doesn't create this damage.
Yeah, it's interesting that the dot-com bubble burst. I found a paper that was written by the New York Fed around 2004, and the argument they made was that the banks survived the dot-com bubble without any damage because they were using securitization so carefully that they'd managed to conquer risk.
Yeah, so the issuance boom, I just want to mention another one that's not so well known, which is the South American mining boom, which is the first emerging market boom, really, and it's 1824. Because one of the promoters of that, writing lots of articles about it, and I'm just going to give you the numbers on this one in terms of new issuance. The first of these mines to list on the stock market were the Anglo-Mexican and United Mexicans, both established in early 1824. Thereafter, until the end of 1825, prospectuses were issued for 74 Latin American mining companies, only 44 of which were still operating by 1826. Benjamin Disraeli was involved in this. Do you want to talk about Benjamin Disraeli? And also why? I mean, why did we suddenly, because I think it goes to politics in a little bit, this maybe fits into the political bubble because the politics changed, permitting all of this, and there was this new El Dorado that suddenly existed that hadn't existed the year before.
Definitely, yes. So I think this sort of ties to narratives in bubbles, how a lot of the time an asset class becomes linked to a very compelling story that people are very keen to invest in. And this was kind of the emergence of a liberal philosophy of investing, of we're investing in these companies to bring civilization to this part of the world, and this sort of imperial.
It had been run by the
liberalism of
Spanish.
time.
You're reasonably civilized, right? So.
Well, it's not be careful what we say here. We're being recorded. Yeah. So this is sort of the idea. I don't know if the British at the time considered the Spanish civilized or not. But there's this sort of political narrative that's driving a lot of this investment. People have a reason other than just trying to make money to want to invest in all of these companies, and they're caught up in a lot of what you say, that these compelling stories of the riches to be made in South America. It becomes very exotic.
I think Disraeli loses so much money, it takes him decades, I think, to pay back the money he loses in this, in his role in promoting these things. What we haven't talked about in any detail yet is money and credit, which I think is particularly important. Banks create money. It's worth reminding everybody of that. Money is not created by the central bank or the government. It's created by commercial banks. So what about the ones where the commercial banks aren't involved? We've mentioned the bicycle bubble. I mean, can money, and we've mentioned low interest rates, but credit hasn't been a focus of that. Or is the other way of doing this on what we call partially paid shares? Is that how we get the leverage into a system? If the banks aren't lending it, then there's this, maybe you could explain partially paid shares, because historically, it's a way that we can create leverage without going to the banks.
Yeah, it's true. So first of all, we don't have that much leverage in every bubble. So the bicycle bubble, the shares are mostly paid up, which is why there's not so much economic fallout. But the one prior to that in the book, the Railway Mania, this is the form of leverage. It is partially paid shares, where you have a £100 share, for example, but maybe you're only paying £5 up front, and as part of ownership of that share, you're on the hook for the other £95. It's some unspecified or specified point in the future. And this makes them a very good instrument of speculation. It's essentially just margin trading, but the company is issuing them in such a way as to bake that into the issuance of shares. So you're right, it's not always just the banks. Another thing about so if we go to the Wall Street crash, for example, in 1928, and 1928 is the point when dividends and share prices are actually starting to diverge. The Federal Reserve starts putting a lot of pressure on the banks to stop issuing broker loans, to stop all of these new investors coming in and borrowing in order to buy shares and speculate on shares. But all that happens is that corporations and foreign banks just step in and offer those margin loans anyway. So you're right, a lot of the time it's not the banking system. The banking system is the part that people typically worry about, and rightly so, but you can also have leverage in a bubble that comes from many other sources.
Yeah, I think I've seen some statistics that by that 1929, quite a lot of the margin loans were coming from Canada, because that would be unregulated by the Federal Reserve. So the market finds a way to create leverage even if the banks don't provide it, and even if the central bank or the regulator's trying to stop it. It's a very difficult thing to stop, particularly in a world of free capital flows where it can come from overseas.
Yeah, and the other thing to note is that they were borrowing more and more in margin, even as the interest in those loans was rising quite substantially. So if people want to borrow lots of money to invest in shares, you can increase interest rates, but if you're speculating, if you're a day trader, the difference between 5% a year, 6% a year, 7% a year on a margin loan probably isn't that much. So I think a lot of it was also just demand side driven. It's coming from the way that people want to invest.
Yeah. So, I mean, the narrative of that second half of the 20s is a Federal Reserve that wanted to do something to calm speculation, but didn't at the same time want to harm the underlying economy. And they didn't get that right. Do you think we've progressed on that, do you think? Do you think we're better at trying to sort of somehow control speculation without having rates at a level that hinders fundamental economic investment and growth?
So what's changed, and this gets us to the entirety of Edward's speech last night, what's changed is that now the Federal Reserve is very explicitly focused on consumer prices and inflation targeting, which means they're not really thinking about speculation at all. They're very worried about deflation, and so the key point is how big a problem would consumer price deflation really be. But something like 2021, whenever we had this sort of enormous amounts of speculation, and a lot of investors were looking at it and thinking, why is the Fed allowing this to go on? It's like, well, they have very set goals now that mean that they're not really supposed to be thinking about that. They're only supposed to be thinking about consumer prices, which obviously they still got wrong. We still experienced inflation, but we've essentially excluded central banks from thinking about this type of thing.
Yeah, I mean, I think Greenspan used to say that his job was to clean up after a bubble. That basically bubbles were not really of interest to him, but cleaning up after them. Well, I mean, in terms of moral hazard, it's hard to think of a situation of more moral hazard where your central banker claims that he is there to save you from the consequences of bubbles, but not to stop you from enjoying one.
I would say that there are some examples in history of central banks increasing interest rates to try to burst a bubble and it going disastrously wrong because they're such a blunt instrument. They affect so much of the economy, but the bubble asset might be very minor. So Germany in the 1920s did this. They thought, oh, there's a bubble in the stock market, we'll increase interest rates, and this is how they sort of immediately trigger their own Great Depression. I saw one scholar putting it that you have two possibilities where there's a bubble. Either the banks are on the hook or the banks aren't on the hook. And if the banks are on the hook, then increasing interest rates is going to just immediately trigger a financial crisis. But if the banks aren't on the hook, then the bubble's not really anything to worry about, because if it bursts, the fallout's going to be relatively mild.
Yeah, so I had this conversation in 2002 with Paul Volcker. And Volcker had just taken over Anderson's, which was going bust, and he couldn't save it. And we discussed the banking system. His view then was that the banks, through securitization, had managed to offload so much risk that actually the balance sheets weren't risky. Now, that turned out to be disastrously wrong because a lot of that risk came back onto the balance sheets. So here we are, post that. Where are we, do you think, with banks taking risk? Clearly, their balance sheets are less geared in the formal sense of that. But is there a risk that, again, somehow risks rebound back onto their balance sheets as they did in 2007-8? Because smart people, and you don't get much smarter than Paul Volcker, thought that this risk had been diversified, and somehow it wasn't diversified.
Yeah, so it's very hard to spot. I would say that the authorities tend to be very careful about not making the same mistake twice, so sometimes too careful. So after 2008, that this was the type of crisis we got whenever the banks were in trouble, the banks were going bust. And now you have this enormous infrastructure that's trying to be very, very careful about looking at every possible exposure, every possible contagion mechanism, and try to shut that down. There's also the fact that everybody knows the banks are going to be bailed out, so you've got enormous amounts of moral hazard on one hand, but which they're sort of trying to just control with more and more regulation. But on the other hand, that they are underwritten, and we saw this with Silicon Valley Bank and the other banks that failed last year, that they're going to be bailed out.
Well, the interesting thing about Silicon Valley Bank, it went bust owning the risk-free asset.
Right.
And that is quite something. And you know more about the history of banks than I do. Do you know any other bank that's managed to bankrupt itself owning government bonds?
Well, I mean, I don't know about some government bonds. You could definitely find emerging markets where this was the case, where the government's debt was, they're often forced to hold the government debt for regulatory reasons.
That's what I was trying to get to. So the Bank of England now has two committees, which is the MPC, which is the one that's always on the front page of the newspapers, but also is the FPC, which at one stage was known as the Bubble Committee, and it tries to do what you're suggesting by changing regulation to steer credit away from speculative assets. But one of the things they try to steer them towards is the risk-free asset.
Yeah.
Edward mentioned last night, I think the Austrian government bonds down 90%. You certainly lost 45% on 30-year treasuries. So, you know, they created another problem by this so-called risk-free asset. I mean, it's risk-free in that it always pays principal and interest, but the price is far from a risk-free asset. So we certainly know lots of emerging markets have gone bust doing this.
Definitely.
But we have a lot of banks today heavily weighted into government bonds.
Yeah, definitely. And it's also worth remembering that mortgage-backed securities were supposed to be safe.
Yeah.
The whole point was that these were supposed to be safe, and the government was encouraging them to hold those types of assets. It also links to the fact that there's a political economy story going on, where the banks, to some extent, get a say in what counts as a risky asset and what counts as a risk-free asset. What we saw in the 1980s in Japan was that banks could actually count unrealized capital gains on stocks as capital, which is absolutely crazy with hindsight, but they managed to lobby for it and say, oh, well, this is how the Japanese economy works, and we have our own unique culture where this is appropriate. So, yeah, a lot of the time it is the asset that everyone thinks is safe is the one that causes the problems.
So you mentioned this period, 1945 to, let's just say, 1987, where I won't say there are no bubbles. I mean, there's a few banking problems, obviously, particularly here with NatWest in 74, and Franklin National Bank goes bust in America. But on the whole, it's a period without bubbles causing financial distress. What do academics think attribute that period? Let's call it a period of stability. What do academics attribute that stability to?
So this is another of your the topics that you're very much on top on, is financial repression.
Yeah.
And what they do is essentially try to tightly control the three sides of the bubble triangle. So this is the area of capital controls. So it's much more difficult for money to cross borders. You don't get these influxes of money into emerging markets that generate bubbles later in the 80s and 90s. Credit is also controlled, who banks can lend to, what rates they can charge is under very heavy regulation. I mean, that this ties into marketability as well, that it's harder to trade things across borders, it's harder for foreigners to buy certain types of assets, and so on. So it's essentially constrained by, with this very tight set of regulations, which, as you say, might be a world that we actually return to. And there's a cost to all of this. So I'd say the ideal number of financial bubbles in the economy isn't zero. There's a trade-off between allowing for freedom of movement and allowing people to take risks, and banks to create financial innovations and do things that previous banks haven't done. But if you did want to have an era with no bubbles and really shut that down, it would be financial repression.
Yeah, it is worth saying that bubbles leave behind something. I mean, I've lived through the Asian financial crisis. I've written the book on the Asian financial crisis. Did leave behind some very nice hotels.
Yeah.
Some very good airports, some lovely infrastructure. So it's not as if it was all kind of wasted, if you like. There was some tangible results. That early dot-com bubble produced a great big fibre network, that, you know, a massive overinvestment in fibre, which allowed subsequent the internet to run on. So the dot-com bubble being a good one, because the casualties of that seem to be rather limited, but it did leave behind some decent assets. So your opinion is it's a world where we need bubbles, is that?
Sometimes, yeah. I'm not fully weighing up the benefits and costs or anything, but the benefits are there. And if you think of, so I say a low interest rate economy and how this leads to lots of money going into the most speculative companies, it also means lots of money going into the most innovative companies in an era where There may be too little investment in research and development, or it may not be very rational for investors to be thinking about putting money into research and development. All of this cheap capital for innovation-intensive firms might not necessarily be a bad thing. So there are definitely upsides to bubbles as well. And again, a lot of it depends on the fallout. So who's on the hook whenever it bursts, and how is it going to spread through the rest of the economy?
Now, you, unlike me, you've put your head above the parapet on crypto. So, and there's lots of people, younger people in the audience. So here's the triangle. Talk us through crypto.
So money and credit, we all know about, and there's low interest rates. One thing we might not know about is that crypto had its own money supply, which is in the form of Tether, and the supply of Tether, which was run by a private corporation, was used to create all of these synthetic dollars that could only really be used to buy crypto assets, so that the money and credit side of the triangle was even more significant for crypto than it was for many other assets. Marketability, so these crypto assets were easy to buy and sell, largely through non-compliance. So you transfer them, and you aren't thinking about things like your customer regulations. You're not thinking too hard about who you're sending it to because they're anonymous, or who you're buying it from because they're anonymous. And this is kind of an increase in marketability. It's not so much technological as it is political, or it's an innovation that allows you to circumvent some of the controls on marketability that otherwise exist. And then speculation, which I think is probably the main use case for crypto. What most people actually use it for is simply buying it because they think the price is going to go up. And because crypto has no cash flows, we know that this is the only reason anyone would invest in it. So we don't have to think too hard about whether this was really the case or not. And then this market is sort of, was it politics or was it technology? And there is a technology in the form of these crypto assets, but it's also political because it interacts with the fact that political restrictions are the thing that the technology is trying to avoid. And other political factors, such as the difficulty of prosecuting white-collar crime today and in enforcing all of these financial regulations, particularly in the crypto sphere, is a major factor too. And all of this combines, and we get, I think, repeated crypto bubbles at this point. It just keeps bubbling and busting every few years.
I think we should probably just go to Q&A now and get some questions, because I know there's a lot of experience to do. And there's one straight away right at the back. Can I have a few hands up? Because we're going to pick three out. And okay, so for whoever's got the microphone, we're going to go number one right at the back. And then this gentleman in the glasses here, and then right down the front. Those are our next three questions. One at a time, please, but those are the next three questions.
Sorry, I accept my fault. I totally missed that.
Okay, this gentleman at the back is number one. Gentleman in the glasses here, number two, and right down the front, number three.
Okay.
Thank you. Historically, what do you think is the longest running bubble, and what factor do you think kept it afloat so long?
That's a really good question. Well, ask me in a few years and I might be talking about the Chinese real estate bubble. I think to a large extent, how long a bubble is dragged out depends on the actions of governments. So sometimes governments see that the bubble is about to burst and try to find some measures to prevent that from happening. Engineer a soft landing. This happened in the 1890s in Australia, that the housing bubble there was really dragged out beyond the point where it was sustainable without government intervention, and a consequence of that was that whenever the crash came, it was all the more painful. I actually think that the timeframes on bubbles are getting shorter more recently, because the news cycle is so much faster, and now you have a hype cycle that's maybe over within a few months. Something like NFTs, they were everywhere for a couple of months and then they were gone again. So I think that the more historical bubbles may have been the ones that last longer, but I think that's largely determined by politics. And as I say, what's happening in China might end up being the real answer here.
Just on that land bubble, because you've got a whole chapter in here. It's not well known, but it's an incredible story. So my recollection of the data is the peak price for Melbourne centre real estate of the 1890s wasn't surpassed in nominal terms until the 1950s.
Yeah.
Yeah. So that's a bust. That's the other way around. That's the opposite of your question. How long did the bust last? That
Also, that more than half of the major Australian banks failed.
Yeah.
So that's one of the worst banking crises in history. Probably the most destructive bubble in history. What was this Australian land boom? So.
yeah. Question.
One of the difficulties in deciding whether you're in a bubble this time or not is that you may think this time it's different, especially when it involves a transformational change in the real world, okay? So when we talk about AI today, is that a bubble or not? And I think no one would disagree that AI over the next, 5-10 years will have a material impact on the real world, increasing productivity, et cetera, et cetera. If you look back to the bicycle bubble in 1890, so if we were sitting here in 1889 or 1890, I mean, how can you and we all know what impact the bicycle had on the real world. So I think it did increase productivity, probably not as much as people expect. So how do you decide if AI is the bicycle bubble or if AI is really a fundamental transformational change where valuations of however many times are actually quite reasonable, because in 5 years' time...
What I would say here is that when you want to determine whether you're in a bubble or not, you're not valuing the technology, you're valuing the companies. So you can have AI companies who are basing their entire sales pitch around, we're an AI company and AI is going to change the world. But in reality, what they're doing with AI is not very useful, or they're simply repackaging freely available AI using a different skin, or they're simply not going to be the ones that benefit if and when AI comes to dominate. And this is a theme as well with the dot-com bubble. So around 2000, people weren't necessarily talking about, is Amazon overvalued or is pets.com overvalued? They were talking about the internet, and whether you think you're in a bubble or not is almost proxied for by how big you think the internet is going to be. But of course, the internet was absolutely transformational, but we were still in a bubble. That's what I would say. I think it's important to understand the technology, but also you're valuing a company, you're not valuing a technology.
Yeah, there is a pattern here. So there's a very good book on this by Alistair Nairn, Sandy Nairn, called Engines That Move Markets. And Sandy looked at all of the technology bubbles from the canals, really. And obviously, when the technology comes, you get a great rise in speculation in exactly what Will's talking about. You then get a bust. And then you find out who the winners are. Then you find out who can do this. So Amazon would be the classic example. We know with the benefit of hindsight, the dot-com bubble, even buying Amazon at the very peak was a fantastic investment. It did fall 90% first up. It was in this class where you couldn't really pick the winners. And maybe there were some very smart people who picked that as a winner and held it as it fell 90%. But there's always this early shadow where we're all speculating on who's going to get the cash flows from this. So a nice practical example, there's a listed firm of lawyers. When ChatGPT came out, the share price went sharply down. The belief was that ChatGPT would replace lawyers, more intelligent, more character. I speak as an ex-lawyer. But then suddenly it started going up, and it's at an all-time high, because now the view is that AI actually is going to help the profits of law firms. So in that first bit where we're all trying to speculate on revenues and costs, you do get a bubble, you then get a fall, and that's, based on his book anyway, that is when you'd be looking through the rubble. The winners are there, but as Will says, they're probably overpriced, and then we'll begin to find out. I think the one thing that maybe is different is that NVIDIA, for instance, has a lot of revenues, and when we look back at some of those companies, including, they didn't, but Amazon did have revenues. So there is this pattern. If you read the book, you'll see it. There's kind of this great speculation. There's a great fall, and that's when you tend to invest. If you can pick the winners, even picking the winners in the rubble is difficult, but picking the winners at the top is particularly difficult because there's such a huge range to choose from. And in the rubble, that narrows a bit. Narrowed spectacularly in the dot-com bubble. Emil.
Will, with respect to systemic bubbles, ones that bear systemic risk for the nation, we have to involve banks. Have you come across in your work some system of banks, some national system of banks that seems to be I don't want to use the word impervious, but reticent, somewhat set up in a way that seems to avoid these bubbles, or is there no such thing? I'm thinking perhaps Canada?
Maybe. Well, what really interests me, I think finance is a bit like Formula One. It gets most interesting when things go spectacularly wrong. So I think that elements that really fascinate me are the banking systems that perform terribly, and maybe we can learn from those, which ones are actually going to work. So obviously the US in the 1930s, where the banks were very, very small. 2008 is too big to fail. The 1930s are kind of too small to succeed. So many of these banks fail, and that's an example of a banking system which isn't robust at all. And then you have the opposite problem where the banks are very large and they're all exposed to the same thing. I'd say the ideal banking system, and it may just be an ideal that's never existed, is where they're all exposed to different things, where maybe they're all measuring risk slightly differently, maybe they have different balance sheets, and whenever one bank fails, it doesn't cause issues to the rest of the economy. What we have now is essentially banks aren't allowed to fail, which is very much a second best world at best. But ideally, it's the sort of diversification within the banking system where one bank can fail, but it doesn't become, as you say, systemic.
I think also there is also a pattern here, which is that any country that has been through a period of high leverage and collapse tends to not rush into the next one. So I think Asia is a classic example. Most Asian countries are grossly undergeared because of the consequences of 1998 on a very personal basis for corporations and individuals. But Canada, we have to get back to Canada, obviously rode through the 2007-2009 crisis, as did Australia. So now if we look at kind of debt metrics and debt to GDP metrics, if you look at where they're rising fastest on the planet, you come to Canada. And there is this, this is a psychological thing back to this. The willingness and prevalence of using debt in some economies is at an all-time high, but not all of them. We look at the United Kingdom and America, and they're pretty bad, but Canada is much worse on the aggregate metric. So maybe the thing is, if your banking system doesn't fail the first time, it creates overconfidence and it rides for a fall the next time. And then if you're looking at the most rapidly rising debt service ratios in the world, where the cost of interest is really beginning to impinge upon private sector cash flows, you also look at Canada and Australia. So I'm a bit more cynical about the Canadian banks. I think they probably Canadians probably got a bit overconfident. I like to put that in terms of the magazine for Air Canada. So I'm on Canada quite a lot, and I was flying Air Canada one day, and I picked up the magazine. At the back of it, there's an advert for Air Canada, and it says, "The world needs more Canada. Let's take it to them." I thought, I've rarely seen a sign of more overconfidence. I don't know if Jared's here, but maybe Iceland once had the same advert. So a lot of this is psychological, and I think riding through the last problem in Canada probably means that this time there's just a bit too much leverage in the system. Canada's not short. I mean, Canada house prices have been going like that. Canada's not short of land, as we all know. We have time for another couple of questions. Okay. So let's start here at number one, and then there are two. We're going to be here all day. So we'll start with this gentleman, and then there are two. Sorry, there's two at the back as well. Sorry, just a bit too slow. So.
When I was just starting my career and I was a young analyst at Fidelity in the late 90s, there was a famous portfolio manager that stood up in front of the room and he said, "I think there's a bubble developing in internet stocks, and if there's one thing I know, that's exactly where I want to be." So my question is, how do we identify bubbles as early as possible so that we can participate and benefit from them?
Yeah, that's a good question. So some would say it's impossible to time it, but in our research, we actually find that there generally is some element of society that does manage to time it, that does get in at the right time and get out at the right time, and not just through luck. I think just sort of my personal view, it's not necessarily based on research, is that that's all about spotting a really good story. Seeing something almost like spotting a like a pop song where you hear it on the radio and you think, oh, this is going to be massive. And some people are just naturally very, very good at that. So some kind of narrative, I think crypto had this amazing narrative that some people got in on early and thought, okay, whenever more people hear about this, it's going to be massive. And even though the story itself just doesn't really add up, that doesn't matter. It's so powerful that it's just has nothing to do but spread. So I think that would be my only advice, is sort of, if you've got a good eye for a good story, maybe then you can get in on the ground floor.
You weren't a stockbroker by any chance, were you? Stockbrokers have always got an eye for a good story, so at the back.
Perfect. So my question is regards to the China market. So just yesterday, the Chinese banks approved about 28 billion for the property market. According to this triangle, right, what do you think is going to happen overall in the Chinese markets with so much disinvestment from the Western economies, their credit crunch rising every single day, and obviously the real estate market then?
So you'd imagine China is going to contract, right? That this is sort of an unwinding where interest rates are rising, property prices are going to fall. As you say, that there's going to be a credit crunch. But it's really a question of how bad things are going to get. And all I can say is that I don't know. I think to understand how bad things are going to get in China, you need to understand the Chinese economy, which means understanding Chinese politics, which is incredibly opaque. At a minimum, I would want to be able to speak a Chinese language before I would make any predictions on that, because trying to apply sort of my understanding of Western economies and Western political economy to China, I could only possibly make mistakes.
It's interesting to go back to financial repression, because obviously with a communist country, it's made its transition, but it has retained quite a lot of state ownership of the financial institutions. And it makes this more difficult. You know, when we're analysing this, we're analysing markets, market-driven banks, incentives for commercial bankers, et cetera, et cetera. But in China, the state runs the banks. So the way you would expect a banker to behave in the Chinese situation may not be the way the banks actually behave, because they're run by the Chinese Communist Party, which is different than this, back to this political economy. And we have some expert political economists here at this conference, so we'll be hearing more from them. But it's I think it's one of the lessons of the modern era, isn't it? We need more political economy. And as you say, unless you really understand that what the Chinese Communist Party wants to do with its banking system and asset prices, this is not a market call. Yeah. This is a political economy call. Yeah, there was one more question right at the back, wasn't there? Yeah.
Hi. So touching on your previous point a little bit about how bubbles might not always be a bad thing, especially with the telecom crash in 2003 and with the rise of internet companies like Google. Do you have any thoughts on how one could position themselves on the winning side of a bubble, if you could even call it that, especially with, for AI? Like right now you only have a couple of companies because the cost of compute is so high. Like let's say there's a bubble and there's a scenario where the cost of compute is so cheap. Like, what are your thoughts on how one could position themselves on the winning side of a bubble, basically? On the winning side, so trying to get in early. So if we stick to the bubble triangle and we have a new technology like AI, which given the amount of hype around it, I think would be a prime candidate for causing a bubble. But if we stick to the bubble triangle, we wouldn't expect it to really take off until interest rates fall again. So that would be kind of the next point at which you would start to try to get in on that side of it. There's another side of it that you mentioned, which is after the bubble bursts, are some of these companies going to be a bargain? And that's something I don't know that much about, but I think is very under-researched. This is the subject of one of Russell's books, is, okay, we hear a lot about the madness of crowds and the stupid decisions that people make in buying these shares that are obviously overvalued. But a few years later, you often have shares that are extremely undervalued, and a lot of people don't buy those shares, but we don't patronize them or talk about them as these sort of naive idiots, the way that we sometimes talk about the people who buy bubble stocks. So I think that's something to address, is when are we at the bottom? And maybe, Russell, you want to talk about that?
Well, what I would say is, watching this one from the outside, because I'm not at the sharp end of this, I'm not a fund manager, it seems to me there hasn't been enough new issuance yet for this one to be over. Now someone's going to put their hand up and say, I've got 150 prospectuses for AI stocks on my desk. If so, I'll have to revise that. But normally now we'd expect every investment banker in the world to be concocting an AI story for a stock of some sort. So maybe it's got a bit further to run to suck in that bit, because that has been a feature of all of them that you've looked at? I mean, new issuance has been a feature of all of them, and I think we're just, if it is there, it's only just getting underway for AI. So there'll be lots of speculative new issues on AI. So yeah. There was one lady in the middle. We got
room for one more question.
Would you like to ask the question? Yeah. Just wait for the microphone.
Mine wasn't so much a question. Sorry. Mine wasn't so much a question as a comment. And one of the things that I thought was interesting about your exposition was the concept of the informed insider, if you want to call them that, and the sort of outsider. And in the most recent bubble, which I would call the bond bubble, and I'm a former bond fund manager, the thing that was absolutely extraordinary about it was that I don't know a single fixed income fund manager of my generation, i.e., 45 plus, who didn't know that it was unsustainable well before quantitative easing to have real interest rates at zero. But we were dinosaurs. We were not listened to. And there was another reason that we were not listened to. I mean, there was a generational thing, which was people who'd never seen inflation or never seen anything couldn't see why this would be an issue. But there was another issue, which is that we fund managers actually can't do what we want with the money. And we had a whole sea of particularly consulting actuaries and trustees and, concocting their rules for investment. And we would have to put things into bonds with long durations, whether we liked it or not. And the more regulation came in, the more you had to do, and then you had the quantitative easing. So this one was entirely foreseeable and was foreseen. It's just that the ones that knew were not listened to or sidelined. Many of us got fired because you couldn't even run a neutral portfolio. So the comment was, you're absolutely correct, but equally regulation as well as deregulation can be a very good source of problems in these markets. And we're still there.
Maybe if we were able to track the age composition of fund managers, this might help. And if you get a sudden spike, in terms of youth relative to age, it's a sign that maybe we're getting into a bubble. I've faced the same problem myself in 1996, writing about the forthcoming Asian financial bubble, which didn't arrive until 1997. Now, if you're a private investor, you might think, well, that was prescient. But if you're in the markets, that was far too early and likely to get you fired. The only answer to that is time horizons, isn't it? So is the length in the time horizon. It's not the only answer, there are other answers, but it's a good one. As Edward said last night, interest rates were at a 5,000-year low, which means that bond prices were at a 5,000-year high. And the recommendation to private investors was 60-40 in terms of your portfolio. So anyway, the lesson from your comment is more financial history, which is why we're here. And it's good that so many of you want to learn about it, but it is something that we are pushing to try and get back onto the syllabus. My friend David, the CEO of a charity, is selling a course in financial history outside. I'll plug that. If you want to go and speak to David, it's online, so you can do that as well. And that is our kind of mission at the Library of Mistakes. It's not rocket science, And I'll just say this in conclusion. The whole reason that the Library of Mistakes exists is because of Jim Grant, which is, Edward mentioned his name last night, and Jim once said that in the physical sciences, progress is cumulative, but in finance it is merely cyclical. And that's what we have been discussing here, and you've explained very well how that works. And we'll never cure it, but we can mitigate, I think. So thank you for coming to help us mitigate. And thank you, and please join me in thanking Will in the usual way. The last chapter of this is called Predicting Bubbles. So if you really want to predict a bubble, you better buy a copy.